right, that's the JP Morgan view on the current situation. Shubham Agarwal is also joining us on the technical front. Shubham, first and foremost, give us a call on the kind of resistance levels that you're tracking. Where do you see the bottom?
Yeah, if we have to look at the Nifty chart, it has clearly confirmed the downtrend. After breaching the lower low of 5,500, it is clearly indicating that the medium-term trend has started to trend down. So what we're expecting now is that this breakdown should accelerate in movement, which is giving us a target closer to 5,200. That is the first target that we're looking at on Nifty. Based on the continuation pattern that is developed. Even if you look at the intermarket studies, the rupee is weakening every day, plus the bond yields are headed higher, which are keeping pressure on the financial stocks. So we expect that Nifty should be negatively biased. If any pullback happens, that will find strong supply around the level of 5,500 to 5,550, and we don't see Nifty crossing that level in near term. So a negative view on index for a target closer to 5,200 is what we're looking at this point of time.
Just pull up the intraday chart of the index once again, trying to move into positive territory as far as the Nifty is concerned. Just a couple of points down, 1 to 2 points lower is what we're tracking on the index there. Just 54.12 back on your screen is what we're looking at. So it's once again off from the day's low is what we've seen and managing to move into higher territory. But let's see if we can sustain or not. Shubham, so what's the strategy then to at current levels? What's your advice to clients? What have you been telling them? Go long right now, or probably wait it out and then short at higher levels? What's the strategy?
So it'll have to be very much sector specific. So if we have to talk about portfolios of clients, then we are making them more inclined towards the IT and the pharma space, which are definitely the safe haven at this point of time. We are not saying that those stocks will not fall. There could be a 5 to 7% correction after the rally of 30% in the IT index for last 3.5 months. But if we have to look at a 3 month, 6 month and beyond perspective, then we feel that these are the two sectors which can still outperform the index. On the other hand, we have seen a temporary pullback coming on metal space, so we are looking to use that as a good selling opportunity because the metal index has been underperforming for last 3 years, and these kind of a temporary pullback are generally for taking a trade with the long-term trend. So after this temporary pullback in metals and even the financials, I think it's a good opportunity to short sell there. So the portfolio has to be more inclined towards the short side because the trend has definitely changed. And if at all people wants to buy, then IT and pharma are the two sectors that we are recommending. Apart from that, auto is one more sector which could see some sort of an outperformance. We can see that the CNX auto is still outperforming the Nifty, but we are not very confident on that. So the allocation in auto is also less. Other than that, all the other sectors are placed on the sell side.
Okay, that's a lot of sell calls coming in. Ashu Madan's also joining us from Religare. Ashu, good afternoon to you. Markets today seem to be trying to claw their way back, Ashu, into the green. It's not succeeded yet, but at least recovered a lot of ground. Where do you stand right now when it comes to the Nifty?
Yeah, I think market is precarious, boys, but I think if you remember last time when we spoke that the market will somewhere break the range and the breakdown has to happen on the lower side, which we have seen. But I don't see that this is just temporary. The way macroeconomic, the overall situation of the market, the individual sectors, the companies, everything is there. I think the impact of everything is yet to be known. I mean, we'll keep on bleeding. We'll keep on grinding for times to come. So this small bounce back or maybe a short-term bounce back would not would not soothe the nerves of investors or traders. I mean, somewhere we are heading down, and I think the gates are open for the downside.
Ashu, that sounds a little worrying, and we've been watching the rupee today as well. But when you're saying that it will continue on the downside, how much further of a fall do you see?
See, it is difficult, to peg a particular number or a level. I think as long as the trend is down, we have to keep trending down. Currently, for the first time, Nifty or the index was defying all the logics and individual stock wealth destruction or the price destruction was happening. But now we have seen that the situation is reversed and, beyond a point, the JP Associates or Unitex of the world from where would they fall? So I think now the bigger sectors are under question and the Nifty would be under pressure. So I feel that probably we are heading lower, and I think creating bear spreads is the only way to trade this market as of now.
So Ashu, looking at today's recovery, you're talking about some gains coming in, gains in the sense from the low that we've actually seen, 5396 as far as the index is concerned. You think probably markets have formed somewhat of a bottom here, or there's more pain left?
No, I don't think so. These bottom could be very, very temporary. I mean, market is in a panic state. As I said, that it is difficult to ascertain the impact of the rupee and the all other ancillary stuff which is happening, the bond yields going haywire. So everything put together, I mean, what the extent of damage still it is not known. So this kind of instability in the market would not attract any value buying also, would not attract any investor or traders who would feel, I mean, the market is now fairly valued or there's certain value in a particular sector or a stock. I mean, that will keep them in bay. And that will further fuel the fall on the lower side.
Right, Ashu, thanks so much for joining in and getting us your perspective on the markets and how you're reading into all those cues so far. Nifty at around about 539697 is what we're tracking. Lance, one sector that's caught the attention over the last couple of days has been the IT pack. Even today, you have a couple of stocks that are actually holding in. I think Infosys was one stock that was actually still in positive when we talk about the way it's panning out, in spite of markets being so weak. Is this probably a pocket to keep an eye out for going forward for this year?
Yes, sure. I think it is an option to keep an eye open, specifically because the currency has appreciated. And the dollar has appreciated vis-a-vis rupee. So to that extent, the margins, there would be some margin expansion for those IT companies which haven't hedged their earnings. And going forward with the US also showing improved demand and improved economy on their front, you could see some additional demand for the IT sector coming in from the US. However, we also have seen that the IT sector had a large bench strength, and how quickly this bench strength gets utilized and what kind of efficiencies you can see in terms of the margins will come from the number of employees they've been able to deploy from their bench into actual business. So one should wait for a quarter or two before making a beeline for these sectors that appear to be very lucrative, because then valuations run out of whack and everyone's queuing up to buy the same stocks, and then we get into a situation where we've bought into something at an overvalued phase. So I would wait it out, and maybe the next quarter results would be an opportunity to assess valuations and then take a longer term call.
Right. What about pharma, Lance? Because earlier we were talking about how the gains are probably overdone now and they're cooling off. Shubham was just talking about how it's still possibly worth a look to stick to defenses at this point of time. Would you still say that?
I would still say that, because pharma has been performing consistently. If you look at the results that have come in the last quarter, we've seen good numbers from companies like Cipla, although Lupin did see a bit of a fall in terms of their overall targets, but their performance was pretty steady. And from almost all the pharma companies, we've seen good earnings results. So going forward, I do believe that they will continue to generate additional revenues as well as profits, and that would be one area or one sector that we can see growth in.
All right, just get some perspective from Credit Suisse as well. In fact, early in the day, we caught up with Nilkant Mishra, head of India Equity Strategy at Credit Suisse, and he says that FI investors are highly jittery about India right now. Speaking specifically about bank stocks, he said that the correction was much needed. Listen in.
What is really happening to India in terms of what's going wrong? There are two different things that are on at the same time. The first is the sudden weakness in the currency, and we'll come to that. The second is a sudden recognition that the banking system is holding assets which are actually unproductive. Now, the second we have known about for a while. Actually, we in particular have been flagging that for quite a while. But the assumption that I think most in the markets had was this would continue. So there would be evergreening of some loans, surplus liquidity will somehow solve the problem. We can keep postponing the resolution of these problems, and that over a period of time, some of these problems will resolve themselves. For example, the real estate NPAs used to be a big issue in 2010, but as the banking system grew its assets, as a percentage, they have become much smaller. So that was the hope. Now, what the tightening of liquidity has done, and the tightening of liquidity by the RBI to control rupees fall, What that has done is it has precipitated the issues. So a lot of the NPA problems are now coming to the forefront. The apprehension that many of these banks will actually now have to recognize some of these problem assets, I think that's rising a lot. The fact that the banks will now have to struggle with their margins, that the loan growth will have to slow down, I think those are problems that are accelerating as well. In some ways, that is, I think, a welcome correction. Having a zombie banking system with a lot of large corporates stuck with unproductive loans, I think that's not very healthy for the economy if it continues for too long. So in some ways, the correction is healthy. I think the problem with the rupee is something that is indeed quite worrying, because, and we put that out in a note as well, that the current account deficit, which everyone keeps harping on, is yesterday's problem. It was last year's problem. The sharp decline in domestic economic growth and the recovery in exports, plus the fact that India has large and growing invisibles meaning services exports, means that the current account deficit in our view is likely to be closer to $35 billion and not $90 billion as everyone keeps talking about. And $35 billion is easily fundable. What is happening right now is that what I would call the equivalent of a run on the bank. We've been talking about it off and on in the last couple of months. There was this fear, there is still this fear that a large number of FII equity investors haven't really pulled money out of India. And what if they did? Because there is a large amount, as of 30th June, there was $195 billion that FII equity investors held in India. And what if even a small part of that was to start going out? What will happen to the currency and what happens to the broader market? And the example we gave was, look, it's like a run on the bank. I mean, for argument's sake, even the safest bank only holds 5% of the cash at one time. And if everyone starts going and asking for it at the same time, there will be a run on the bank and it'll go bankrupt, but it doesn't happen. Now, unfortunately, because of, I think, a lack of confidence and I think some very bad measures about market psychology from the regulators, we are now starting to see a lot of FI equity investors becoming extremely jittery. Some India bulls, people who are relatively optimistic on the Indian market and the economy, are now being questioned internally as to the reason for that happening, and why shouldn't the investors be pulling money out of India till the time that the rupee stabilizes. So I think it is market psychology which is now driving down the rupee. We need some very strong measures from the government and the policymakers to actually stem that loss. Because I think that the root cause of the current account deficit actually has been solved. Right now what we are seeing is just, I think, the broader market panicking. So to answer your question as to what has changed, I think the era of easy liquidity is behind us, both globally and domestically. And I think that is precipitating a lot of problems.
All right, that's the comment coming in from Neelkant Mishra. Shubham, give us a sense now as to what your strategy would be going ahead this week. We've had a couple of sessions of major trouble and then some amount of a recovery coming in today. Everyone is still fairly pessimistic. What kind of strategy would you advise for the week going ahead?
See, in case if the pullback continues, then I would recommend that, around the level of 5,500 from where the Nifty has confirmed that a breakdown has taken place. If Nifty is able to reach around that level, then that can be used as a good selling opportunity, because we feel that the medium term trend has changed and, Nifty can move lower. So around 5,500 would be a good opportunity to short sell. One can look for a target of 5,580, and on the downside we are expecting around a level of 5,200. This could also be played with a bear spread kind of a strategy where the losses can be kept very minimum. But overall, whatever we have to, if we have to look at some of the sectors, then we also recommend that the current pullback that has taken place in the metal stocks, stocks like Coal India and stocks like Tata Steel, can also be used as a good selling opportunity. Now, if we have to talk about one specific short opportunity, Then Coal India has broken down from a long-term support of 290. We have seen recently the stock oscillating between 250 to 270. The stock has already pulled back. We are recommending that as a sell with a stop loss at 275, and we can look for a target closer to 230 to 240 on that.
Shubham, also, what about some of these realty names? Because we're seeing real estate bounce back a little bit today, whether it's mid-caps or DLF.
Right. Even if you look at the real estate as a whole, this is a temporary pullback that is taking place. Sectors which have been underperforming for last 3 years, 3.5 years, we don't see any kind of a bottom formation just because, it has pulled back slightly. So I think for the real estate sector to bottom out, that is a long time from now, to go away. So we expect that this kind of a pullback should be used as a selling opportunity. If we have to talk about specific levels for DLF, then 170 is an important resistance for DLF. So the stock is already around 152 after the pullback. So maybe post a 10-12% kind of a rally if we are able to see on DLF. Post that we can again look for a sell opportunity there. But at this point of time, what has happened is the market has started correcting, but some of the sectors which were heavily oversold have seen some sort of a pullback coming in. So that is the reason we are recommending not to short sell right away. After a temporary pullback of 10-12%, I think real estate pack will also be a good short selling opportunity.
That's DLF there, 2% low, 2% higher is what we've actually seen for that particular counter. That's the other space I want to get your thoughts on is the oil and gas pack. I mean, Kane India, fair enough, you have the entire Vedanta group companies that are actually on the higher note. BPCL though is showing some good gains, 2.7%. Reliance Industries also just managed to support the index to a certain extent as well so far in trade. Is this probably another space to actually watch out for as far as the oil and gas space is concerned? Because on the other hand, ONGC is actually quite weak today.
Yes, I think I would not really look at investing in this space at this point in time, especially with the oil marketing companies, because with the kind of import prices that you're going to see, as well as the amount that they'll have to bear as subsidy, is going to go up significantly. So I would stay away from oil marketing companies. The oil producers, which would be Reliance and Kane, they would be stocks to watch out for, for investment, because they would actually be generating significant upsides. And I think Reliance is a company which one can look at investing in, because they have come out with some new discoveries. They're yet to give details as to how much oil or gas they've located. But going forward, because I see that their non-gas business has also started making profit. On the retail front, they've crossed their EBITDA positive. So I think Reliance could be the dark horse in terms of making an investment at this point in time, and both its businesses could start generating profits going forward, and that would change the valuations of Reliance, and we could see it move out of this narrow range that it's been trading in.
All right, Lance, thanks so much for joining us this afternoon. It has been looking weak, and I know you mentioned auto a little while ago in general, but Tata Motors specifically, what would be your call on that?
Tata Motors, if we look at the medium-term trend, then it has been outperforming the index. Where the index has corrected significantly, it is almost around the mean of what it was quoting 1.5 months back. So we see that there's a good possibility that the stock might hold on to the support of 275. So that should be a bottom for the stock. It should not slide below that. If we see any temporary pullback coming on Nifty, then I feel that this is one stock which can still outperform. And as I mentioned, that auto is the third sector that we are looking at for adding in our portfolio. So Tata Motors is definitely one stock which can outperform from the current level. If at all we see the stock reversing from the level of 275 and taking support around that, we feel that with a stop loss at 260, we can look for a target closer to 320 to 325 on Tata Motors.
All right, Shubham, thanks so much for joining us this afternoon, getting us your perspective on the markets. All right, just a couple of seconds left.